welcome back. You're watching Your World at 10. Now, last week, HDFC closed corporate India's first QIP issue of NCDs plus warrants. That was about 4,300 crore rupees that HDFC collected via that issue. HDFC's Vice Chairman and Managing Director, K.K. Mistry, now joins me to talk about the issue, as well as the capital raising environment and, of course, about interest rates. Mr. Mistry, thank you very much for joining us. You've come fresh out of what is India Inc.'s first NCD plus warrant issue, and we were very keen to talk to you about that. Great timing, because this week we've seen an increase in bond yields, yes. And B, why did you pick that product? I know that you didn't want to do pure equity because of a certain parameter on return on equity that you wanted to maintain.
See, Menka, we have to put in 3,600 crores in HDFC Bank, which is when we exercise the warrants. Our life insurance company probably will need about 350 crores of capital this year, and we own 74% of that. Our general insurance company will need about 200 crores of capital. We own 74% of that also. So effectively, between these three investments, we need to put in something like 4,100 to 4,200 crores.
Sure.
Now, the most obvious thing is you either raise money through equity or you raise money through debt.
Yeah.
If we had raised money through equity for funding this, it would have impacted our return on equity.
Right.
And our whole focus, the way HDFC looks, we have 4 objectives we set for ourselves, which has been historical, last many, many years. And one of these objectives is to keep increasing the return on equity on a year-on-year basis by at least 1 percentage point. So if we keep raising equity, and increasing the capital adequacy and reducing the debt equity ratio, then it's very difficult to keep increasing the return on equity.
Absolutely.
So therefore, a pure equity was ruled out. Also, our capital adequacy is very high. Our Tier 1 capital adequacy is 15% against a regulatory requirement of 6%.
Right.
A pure debt issue would have probably made sense. But the point is that if we are going to use that money for investing in these ventures, and in the P&L account, we'll only be showing the dividend income. So effectively, the return we'll be showing in the P&L account will be 1%, roughly.
Right.
1% being the dividend yield. Whereas if we were borrowing money and paying a 7.5% interest rate, then that 7.5% would be a debit to the P&L account, which would start impacting the net interest margin, and then, it will start impacting the profitability. So therefore, we had to find a structure which takes the good part of the equity, which is a lower P&L funding cost, and also takes into account the good part of debt, which is that the return on equity does not get diluted.
Would you consider that the most winning feature of this product, that
Yes,
the equity
absolutely.
portion
That,
sort of subsidizes the debt portion?
Absolutely. That, coupled with the fact that we've now collected money on the warrant.
Right.
So in this particular deal, we've collected 275 rupees per warrant. Total amount collected being 300 crores. So irrespective of whether the warrant gets converted into shares or not, that 275 rupees is neither to be refunded to the investor, nor is it to be adjusted if he subscribes for shares.
Okay. So, what if you had done it this week as opposed to last? You would have ended up paying a lot more. On the 2-year bond, you're paying 7.15%, right?
We are paying 7.15 annualized on 2 years, which if you take monthly compounding, is less than 7%. And on the 3-year, we are paying 7.85%. Today, if we were to do it, we'd probably end up paying at least 10 to 15 basis points higher on the bond, because bond yields have hardened.
The second thing that could have sort of prompted you to wait was that you were pending FIPB approval, and that meant that you couldn't bring in any foreign investors in either the NCD portion or the warrant portion, most of them being more attracted maybe to the warrant portion. How did that pan out? I mean, do you regret the fact that you couldn't bring in? What kind of appetite, let me ask it this way, what kind of appetite did you see in foreign investors? I'm sure you had a lot of inquiries.
We never spoke to foreign investors. We never spoke to anyone. But knowing the fact that foreigners are in touch with us all the time, and a significant portion of HDFC is owned by foreigners, 75% of HDFC shares are held by foreigners, we are very confident that foreigners would have liked to subscribe to this warrant, and they would have taken a significant portion of the issue size. Now, the call that we had to take was whether we should wait for the FIPB approval, during which period of time bond yields could have hardened, and they were beginning to harden, or we just go ahead with a domestic issue, which meant that on the warrant we probably get a little less than what we'd have got if foreigners were subscribing, but what we would have gained by, or what we would have lost by way of getting a lesser price on the warrant, we'd have gained by virtue of the fact that we got the bond at a lower price.
Okay, so I know you're not very inclined to share names of the investors. You have a total of 19 in the NCD plus warrant aspect.
90 specific institutions.
Yeah,
but if you look at
within their schemes internally, there could be a lot
40,
more.
40 plus.
Okay.
40.
And mostly banks, institutions, mutual funds. funds in the NCD portion and largely mutual funds and maybe a few insurance companies in the warrant portion, correct?
Insurance companies also in the debt.
Any one institution that managed to corner a large part of this simply because they really were very keen on investing via both the NCD and the warrant?
See, I know you have to look at who are the large investors, who are the large institutional investors.
So let me ask that outright. I'm told LIC was was one of the more aggressive buyers of this product.
If you go by what the media said, yes, one of the reports said LIC subscribed to 1,000 crores. I'm neither confirming or denying, but that was a media report. But really, it was domestic institutions, it was insurance companies, it was mutual funds, and it was banks.
So I know that some part of the success of this fundraising is yet to be judged when both the warrant and the NCD list and to see how it trades. And of course, they will be, in that sense, influenced by all the problems that we have in the debt market, not deep enough, etc., etc. But would you prefer to raise future money through this product?
Let me go to contrary to that. I think on the debt side, you can't judge a success of a bond
on the basis of how
15 days later how it trades, because by in those 15 days interest rates could have moved all over the place. Warrant, yes, warrant you can judge. My guess is that if the FIPB approval were to come through, then I would expect that in the secondary market, and I think the secondary market trading should start in the next couple of days. In the secondary market, the warrant will be trading at a premium. Don't forget one more thing, that on the day we launched the issue, the markets, the share market, the stock market, the Sensex was down by more than 600 points. So really the call we had to take at that time late in the afternoon was whether to go ahead with the issue with a 600-point drop in the Sensex, or to just call it off for the day and then look at doing it the next day. And we said, forget it. We have a name. We've decided to do it. We'll just go ahead and do it.
And the response just talks for itself in that sense. Yes. So foreigners, if they do come into the secondary market, will essentially be buying an option on your stock, a long-dated option on your stock, to convert it to an underlying share at 3,200.
To exchange for a share at 3,000 rupees a share.
To exchange for a share at 3,000 plus the 275 that the original owner has
already paid.
Yeah, so 3,000 rupees for a share in the course of the next week. Would you prefer to raise money through this route, or will it yet again depend over the course of the next 10-12 months as you raise capital?
We don't want to raise more equity. I mean, that is
will this be the most preferred route, this way?
If we were to raise equity, if we were to use it for investment, then yes, this would probably be a preferred route. But if we are using it for regular funding of our day-to-day business, probably not. Because we don't want to subsidize debt, the cost of a debt, by diluting even 1% of the equity.
Okay, so it will depend at every point in time what you're raising money for. Okay, let me talk to you a little bit about where we're seeing bond yields this week. Between Friday and Monday, we saw a sharp rise in bond yields. Today, it's cooled off by about 4 basis points. But really, what is... Yeah, this is, what, and for the 10-year bond is what does this indicate in terms of interest rates? I know that last week itself in a press conference you said you don't see rates rising. I mean, we've had SBI come on and say that as well.
I don't see rates rising in a dramatic fashion, if you see. I don't see rates rising to the kind of levels that we saw last year. Some rise in interest rates from the levels that are prevailing now over the next 6 months, I think is likely to happen.
When you say some, can you quantify that?
25 bips easily, 50 bips probably more likely, maybe 75 bips at the maximum, but not much more than that.
Is that going to impact retail borrowing, like for home loans or things like that?
Really,
more so in the
Menka, people do not buy houses because interest rates are high or low.
No, it doesn't. But we would just like to know if rates are likely to go up in that sense in any fashion.
Well, I don't know whether rates are going to go up per se, but I think it is unlikely that you will see interest rates come down from these levels, at least for the next 6 months. Beyond 6 months, anyone's guess.
Beyond 6 months, most people are expecting an even further sort of
possibly going higher, depending on the government's borrowing program and depending on corporate demand. Menka, at this moment, the big question mark is corporate demand. We don't know what level of corporate demand we are going to see for money in the course of the year.
There seems to be some signs of a lot of corporate paper coming to the bond market, so to speak. Now, I know that a few months ago we were all pondering over the question that all this government borrowing that's taking place, will it crowd out private investment? And most bankers were of the view that no, there is enough liquidity in the system, and anyways private investment will only come back when we start seeing growth come back in a substantial fashion. What's your view on that right now?
See, let me step back a moment. You told me that I said interest rates will not rise in a hurry. I'll come back to your question.
Sure.
Why I said interest rates will not rise in a hurry is because there is ample liquidity in the system. So what you are seeing is a very odd situation where banks have raised money, say a year ago or a year and a half ago at high interest rates, and that money is still there. Corporate demand has not been as high as one would probably have liked to see, with the result that there is a lot of surplus money in the banking system. So every day of the last almost 6 months now, we've seen more than 1 lakh crores, that is 1 trillion rupees, lying as the excess money in the banking system going back to RBI in reverse repo.
Absolutely.
Earning a return of 3.5% for banks. Yeah. So that is why I'm saying that even when corporates start coming to the market and start borrowing money, or the government starts borrowing money, you're not going to see interest rates shoot up like this.
Got it. Okay.
And why did interest rates go up in the last few days? I think it's more a steepening of the yield curve. So the 2-year, 3-year bond rates did not go up as much. Went up 5 basis points, 10 basis points at best. But the 10-year went up much more. So you are seeing a steepening of the yield curve. And I think that is a fairly healthy thing.
So would you say that if companies want to raise money, this is the best time to do it if they're looking to raise debt in this financial year?
I think so. I think
this is the best time to do it,
This is as good a time as you will get in the next 6 months.
Okay, so that probably explains why we're already seeing a large pipeline of money wanting to come in. Let me end this by asking you for your sense of the macro environment, both in the country. I know we've had a lot of seemingly bad news on the monsoon front and the drought front, though the last week of rainfall seems to have recovered things a little bit. And what you're seeing in terms of the recovery or the growth recovery in terms of housing loan demand.
See, housing loan is not going to get really impacted by as much by the rural economy as one.
No, not by the monsoon, but I'm saying, from both ends, if you can give me a macro perspective.
See, if you take the period October to December 2008, that was a time which saw a real marked reduction in demand. Real marked reduction in demand. And that was more a function of the fact that people had become nervous about their jobs. A lot of people had become nervous about their jobs. People were not willing to spend money. They were not willing to take on large commitments. Share prices had come down. So on paper, you may not be wanting to sell all your shares. You built up your whatever shares you hold over a period of years.
Right.
And it's really your sort of family jewel.
Your punji, yeah.
But what a punji. But you feel that your wealth has come down when you see that the price has gone. Prices have come down. Property prices have come down. So again, even you're not going to sell the house, but you just feel poorer. So in that sort of environment, people sort of slowed down on buying new houses. But post-January, there has been a pickup. And the real growth in pickup happened post-May. May was probably the turning point. Now, whether May was a turning point because the elections went well, people's confidence level went up, that could be one reason. But I think more important than that was the fact that stock markets started
been rallying already for a couple of months.
And May suddenly saw the spurt in stock markets. So people suddenly found that the wealth had come back. And therefore, then the jobs were much more secure. So that is the time people started going out and buying houses. So May, June, July have been good months. August have been good months.
Okay, so that's on the home loan demand front. But generally speaking, what's your sense of the macroeconomic GDP growth outlook? Because I know we've had economists come in and say, hey, listen, this poor monsoon could actually shave off almost 1 percentage point of growth. So, do you buy into that?
I would say 6% GDP growth. I'm not an expert,
is what
but
your
I think 6%
instinctive
is
response
what my
is to this.
instinctive response would be anything between 5.9 to 6.2, 6.3.
Okay, and the third aspect of this growth bit is the industry that you deal very closely, and that's the real estate industry, so to speak. Are you seeing a sense of confidence come back? Because they're the first people to go out there and start raising
confidence
money.
Did not. Confidence
financial stability in numbers.
Absolutely. Confidence was not there with developers for some period of time. I would say October, November, December, stretching on maybe to March. But post-March and particularly post-May, the confidence is back to where it was.
Because many of them like Unitech have gone out and raised money 2 or 3 different
sizable
times,
amounts of money, so they've strengthened the balance sheet.
Right.
They have liquidity. We've not seen any default on the non-individual segment.
Okay.
Not one non-individual defaulter, or any one non-individual borrower has defaulted in making.
In the real estate industry whatsoever.
Absolutely.
And of course, now their ability to raise funds will only strengthen their balance sheet. So you're not worried on that count whatsoever. All right, Mr. Mistry, thanks very much for joining us, not just to explain why you picked the NCD plus warrant product, but also to talk about interest rates and the fundraising environment. K.K. Mistry there, Vice Chairman and Managing Director of HDFC. Time for us to take a quick break. We'll be